Is investing in European investment platforms complete waste of time or really great tool to diversify your investing portfolio? Well, let's find out, and in this video we will understand basic characteristics of investment platforms and where you could actually invest in these platforms and what are the potential returns. So first things first, what are investment platforms? I would say the best description of investment platform would be something like small bond exchange. Because if we look at major bond exchanges or bourses across Europe, we see that we have mostly stock exchange, bond exchange and investment funds. And in bond exchange we could actually buy government bonds or corporate bonds which are sold and bought by investors and sellers, like pretty obvious, right? And it is governed by a central regulatory agency and they have certain requirements how you could actually sell these bonds, what are the clearing procedures and all those technical stuff which has been here for, I don't know, 150 plus years. Effectively, investment platform is something like that. This is a regulated institution which is regulated in one or other European country, which simply facilitates buying and selling of investment securities. In this case, those would be loans or bonds where company is issuing debt and investors are buying this debt. So effectively, this is the same. We are buying something that has issued to raise capital. So that's why I'm saying this is kind of small exchange. So this is their business model. Investment platforms are simply middlemen. If they are not lying and they are not doing anything fraudulent, they are simply facilitating that one party is raising capital, another party is buying capital, and for that they have support, they have platform, they have clearing operations, they sometimes provide liquidity, and they are making cut from these operations. Simple as that. So effectively for you as an investor, it's completely irrelevant whether you are buying bond on stock exchange or debt or investment in investment platform if you understand who is the issuer and what are the specifics of specific financial instrument. Because effectively what you are buying investment which will give you specific amount of passive income. So that's the idea of investment platforms. For you as an investor, most important thing is to understand whether this is safely regulated, whether it has good customer support. They will tell you what to do, what not to do, and see how actually these loans or bonds or other products have historically performed. And platform has to be transparent and show what to do. So that's the general approach. Most important thing here is not to get caught on fraudulent cases where you could have very bad quality investments or outright frauds. Because unfortunately in Europe there has been cases where there might be deliberate fraud or simply negligence where the platform has been issuing low quality stuff. And you have to avoid these both scenarios. Other than that, business is pretty straightforward and there is nothing wrong with the business model itself. Now, second question is about those investments themselves. How good are they and are they worthy comparators to, I would say, investment grade securities? Because let's face it, in most cases, those who are raising capital in this way has reasons why they are doing this particular capital raise rather than they go to major investment banks or commercial banks, because those banks usually wouldn't take them. That's why they are going to investment platforms. And then ask yourself whether they are able to pay that kind of money to manage their businesses. Because if someone gives you like 8 or 10% yield, they also have to pay issuer or the platform who raises capital in your place also another fee. So effectively they have to pay 12 to 14% per year, and they have to do it in the way they are actually making money for their own business. So this is more question about the business itself which is doing this kind of deals. And their question gets tricky, because ask yourself, if you are going to investment platform which has lots of these loans, do you objectively have measure how you could evaluate quality of this specific loan or bond? I don't think so, because for me myself it's really difficult to see which company would fail, which company would delay payments, and which company actually would have no problem in doing that. Best I can actually do is make some educated guess and make some reasonable deduction. For instance, if company has business model that could accommodate these types of payments. Let's be honest, something like payday loans, whose business are completely unethical, they are issuing either corporate bonds or these types of loans with very high yields. But they have absolutely no problem to paying them. So you could go to some company which issues bonds or loans which finance payday loans for 12 to 14%. They could cover that easily because those payday loans would be having yield 45 to 50% per year. So for them, that's not a problem. That's the way they raise business. That means if they do business in this way, they are immune to central bank rates, interbank markets, and all other stuff which is really relevant to someone who raises capital in a regular way. Actually, that makes pretty good sense for them. And to be true, it's a very good business model for all parties except those who are at the end of these loans, which have to pay tremendous interest. So, like it or not, for them the business model works. I would say if you are diversifying between payday loan companies, unless we don't have huge economic recession like we had in 2009, there is very little to worry about, providing this is diversified. Another business models which might be working well are companies which probably has very stable business history, which works from year in, year out, and they probably have ways how they actually manage their debt and manage their, I would say, debt expenditure. So if you see that someone is issuing these kinds of debts for 10 or 15 years and their balance sheet is okay, probably it's rather safe bet, but you cannot know a specific company for sure. So I don't want to go and say that this company is good and this company is bad. Where I might have an issue, with company which has unstable business model or unstable business history, or one which is very young. There might be some red flags. Crowdfunding companies might have way more red flags than companies that issues payday loans or something like, I don't know, huge agricultural company who works 30 years. Because you don't understand their business model and don't understand where they are investing. And historically, most of the frauds or I would say bankruptcies has been specifically in some sort of young companies or young ambitious projects which are raising money with crowdfunding, which doesn't have clear due diligence. So that I would say is the red flag. So to conclude, actually the business model of investment platforms is not bad if you understand it. The way the companies raise capital via investment platforms are no different than companies raising money in the bond market. But for investors, the fact is it's impossible to say which loan or which bond will perform or underperform. So best you can do is to have understanding of company's business model, whether this actually fits for their business model to pay these kinds of high debts. If it is, this is good sign. Then you could actually broadly diversify these types of investments. And I would say you are set. You could actually make 8 to 10% per year with fixed income if you have like 20 or 30 fixed these kinds of loans or bonds in your portfolio, because the probability that they would all go and default it's very low. Problem starts when you are investing in young ambitious projects without any due diligence, which actually smells like fraud. And this is where people actually lose money. So the problem is not with investment platforms. Problem is that there are cases where the business models are bad and you have to steer out of red flags, which simply smells like fraud. If you are able to do that, and most importantly, as I'm saying always, widely diversified, I would say this is pretty good investing approach. And in later videos, we will see specific investments, specific investment platforms and ways how to invest in these in the best way and how we actually could steer away from these red flags I just mentioned. So stay tuned and wait for my next video.